the Bitcoin is a stronger form of capital preservation than your house, than a bar of gold, than a bunch of silver, than a stock, than an index, than a credit instrument, than a stack of currency. All of those things are weaker. And when it comes time to sell something else. Bitcoin will keep you, you've got $200,000, you bought a sports car, good for you. You'll be wealthy for a decade. You have $200,000, you buy Bitcoin, you'll be wealthy forever.
As Bitcoin matures from a speculative asset into a strategic reserve, investors are increasingly asking whether digital scarcity can create generational wealth. Michael Saylor is the founder and executive chairman of Strategy, MSTR, a publicly traded business intelligence firm and holder of 846,842 Bitcoins that he founded in 1989. Michael Saylor reveals that Bitcoin is evolving into the ultimate long-term store of value, describing it as the crown jewel of the digital age. In his view, Bitcoin is even more valuable than the most desirable real estate on Earth, earning the nickname Cyber Manhattan. Saylor argues that Bitcoin's scarcity and durability make it an asset capable of preserving wealth for generations, potentially benefiting descendants centuries into the future. To support this vision, his company has accumulated roughly $60 to $70 billion worth of Bitcoin, treating it as a strategic reserve asset. While Bitcoin has delivered exceptional long-term returns, its high volatility remains a barrier for many investors. Saylor notes that most market participants prefer steady, low-risk returns similar to those offered by traditional banking products. As a result, his strategy focuses on separating Bitcoin's powerful performance from its volatility through credit-based financial structures. Meanwhile, long-term holding trends continue to reinforce Bitcoin's role as digital capital. Supply is increasingly concentrated among long-term holders, suggesting that investors are treating Bitcoin less as a speculative asset and more as a durable store of value for the future. Stay ahead of the curve, subscribe, and share for more Bitcoin insights.
Wealthy, right? Bitcoin is going to have economic value 500 years. And Bitcoin, I think, is even more valuable than most desirable in your favorite place. Bitcoin is going to be around. It's Cyber Manhattan. 1,000 years from now, your children's great 10x grandchildren will be a reserve bank. We have a reserve asset. Bitcoin. So we've accumulated $60, $70 billion. We will sell credit. We are stripping the performance and the risk off Bitcoin. Bitcoin's got 40 vol and it's got high performance, but most of the world's zero vol. They want a bank account that pays them 10 or 11.
In the future of finance, Bitcoin may not just store value, it may power the entire credit system. Michael Saylor reveals that Bitcoin is emerging as the foundational layer of the digital economy, serving not only as digital capital but also as the basis for a new financial system. According to Saylor, Bitcoin's scarcity, liquidity, programmability, and borderless nature make it a unique asset capable of preserving wealth while supporting the creation of digital credit. For every dollar of Bitcoin capital, he believes 10 to 20 cents of credit can be created, enabling investors to generate stable yields while benefiting from Bitcoin's long-term appreciation. Saylor argues that this digital credit ecosystem will power everything from traditional finance and DeFi to yield-generating products and banking services. As one of the largest Bitcoin buyers, his company aims to continuously expand digital capital and create trillions of dollars in credit backed by Bitcoin. He views Bitcoin as a decentralized asset free from governments, corporations, and central banks, making it the cornerstone of digital value. In his vision, Bitcoin, digital equity, and digital credit will work together to transform global capital markets and shape the future of finance. Let's get back to interview.
If you want to be more aggressive, it's okay, well, give me the 10% and I'll lever it up 3 to 1 and I'll get 25% yield, like in DeFi. But I want to preserve my principal. And the general idea is people, if they have a certain amount of wealth, they don't want to risk it all in order to make more. They want to put it to work in a responsible way, and they want to comfortably compound their wealth. They want to manage it. And so our end game is to create that digital credit for every dollar of equity capital of Bitcoin that we have. we call it digital capital. For every dollar of digital capital, you can create 10 to 20 cents of credit. And so we've sold about $10 billion of credit. We've created $10 plus billion of digital credit. We'll create $20 billion of digital credit over the next year or more. Then we'll grow that 30 to 50% a year. So 20 billion to 40 billion to 60 billion to 80 billion. And what's the long term? So say we have $1 trillion of Bitcoin, of capital. Well, we can have 200 billion to $400 billion of credit, and that then pays a fraction, 10% yield of the performance of the capital. Long term, the capital should be going up 20% a year, and then the credit could be paying 10%. And so what we're doing is we're creating this digital credit, and that becomes the basis, the fuel of the money economy, of digital money, digital yield, DeFi, TradFi. How big is the market for 10% return of capital dividends on an investment grade credit instrument? There's $300 trillion credit. And that $300 trillion of credit gives you after tax about 350 basis points. And then because we're doing that, that creates amplification for the equity. So our common shareholders, MSTR shareholders, they outperform Bitcoin. So if Bitcoin does 20% over the long term, they would do 30, we would expect, or 40, right? And right now, say Bitcoin it did 40% a year for the past 5.5 years, and our common stock is 60% a year. So we give amplified Bitcoin to the equity holders. We give damped, low-risk Bitcoin with cash flows to the creditors. And then because we're actually raising that money, we're the biggest buyer of Bitcoin. So we're powering up the Bitcoin network. And if you're a capital investor in Bitcoin, well, the Bitcoin price was 10,000 when we started. It's 80,000 now. There's $1 trillion of wealth that's been created. We're not the only actor, but we're an actor. So our job is to power up the Bitcoin network and keep driving that network. And I think we'll buy it at 100,000. We'll buy it at 200,000. We'll buy it at 500,000. We'll buy it at 1 million, 2 million, 4 million, 8 million. So it's a very simple business, which is just drive Bitcoin to millions of dollars, expand the capital network to $100 trillion, hundreds of trillions of dollars, create trillions of dollars of digital credit, and then create a lot of money for our common stock shareholders. And then the last point I'll make is there's a thriving ecosystem. Right now, if you look downstream of us, corporations are using our credit to power them. People are using our credit to power the ETFs. Companies like Apex and Saturn are creating yield coins that like stable coins that pay you 8% or 10% or 15%. And those tokens or yield coins are going into DeFi protocols, and people will loop that and generate 25 or 30%. So there are yield products, investment products, yield coin products, digital tokens, public funds. At some point, I think a bank, wouldn't it be nice if your bank just said, we'll just give you 8% on your money instead of 0% or 3%? Why not, right? And so at some point, we will power bank accounts, we will power crypto accounts, we will power yield coin tokens, we'll power DeFi and finance and trading, and of course we'll power the people that don't trust any of it. Like let's say you hate all of it and you don't trust corporations and you don't trust crypto. You just want to hold the Bitcoin, hold your own keys, be self-sovereign. We're powering you up too, right? You're gonna own Bitcoin that's worth $1 million a coin, and you're not gonna have to trust anybody. So everybody kind of gets what they want. And we're even powering the TradFi people, like investors that buy private credit or junk bonds or investment grade bonds. They're buying illiquid, low yielding, risky instruments, and we're going to give them something twice as good or 3 times as good. So we're really just in the business of fixing the money and digitally transforming the capital markets. And we're creating this digital equity class, MSTR, digital capital, BTC, and digital credit, STRC.
Bitcoin's evolution from a speculative instrument into a structured financial foundation signals a broader transformation in global capital markets. As institutional adoption deepens, the asset is increasingly being positioned as digital capital, scarce, borderless, and resistant to traditional monetary dilution. This shift is not only about price appreciation, but about the infrastructure being built around it, where credit systems, investment products, and yield-generating mechanisms begin to emerge on top of the Bitcoin network. By enabling the creation of credit backed by digital scarcity, a new layer of financial engineering is forming that bridges traditional finance with decentralized ecosystems. Over time, This structure has the potential to expand liquidity, improve capital efficiency, and unlock new avenues for wealth preservation and generation. As long-term holders continue to concentrate supply, Bitcoin's role as a foundational reserve asset becomes more defined, reinforcing its position at the center of a rapidly evolving digital financial era. Is Bitcoin about to become the foundation of a new global financial system?